Hello, everyone, and welcome to episode 22 of Mortgage News Live, coming to you from Radlett Village today. Now, I've got to be honest with you. First of all, thank you for joining us, and thanks as always to our sponsors, MPowered. We do have an intriguing show lined up. It's going to be particularly intriguing because I got back from holiday late last night and my computer's completely crashed. So I have no script. No of my usual preparation, but we're just going to dive in and see what happens. Now, what I've gleaned from being away is that swap rates have continued to go down. Yay! And we will talk to some of our experts about that later. And lenders are cutting rates here, there, and everywhere. There's some more today with HSBC and TSB who've been cutting rates today. So it's a very interesting backdrop. And against all this backdrop, we're going to talk about a lot of things. We're going to talk about particularly about long-term fixes and long-term interest rates. So it's going to be a very interesting one. Look, here is my computer help desk now calling me, but they're too late. And I've actually sworn at them for the first time ever today. So I will apologize to them later. But anyway, so joining me today after that rambling nonsense is Stuart Cheetham, the CEO of MPowered Mortgages. Hello, Stuart.
Hi, good to see you.
I'm delighted to have Arjun Verbeek, the CEO of Perenna Mortgages. Hi, how are you?
Hi, Monty. Very well, thank you. Love to be here.
Good, welcome. And we have back with us a man who nowadays doesn't need that much of an introduction. It's Lee Karasavas, or what's it? Lee Karaswapas. Is that right?
Oh, very good.
Yeah, thank Rich Merritt for that one. But yes, welcome everyone. How are you all?
Welcome, Lee. So Lee's the MD of Prolific Mortgage Finance. And as usual, we have comments. Please, because I've got no questions prepared. Any questions you have from the floor? I'm not that bad, seriously. Then please do join in. But first off, let's dive straight in then. So obviously I have been looking at emails while I'm away because I'm pretty sad like that. And Lee, it looks as if swaps have continued to get lower. What's the latest in the swap world then, Mr. Swapper?
It's been quite encouraging. They've been pretty stable with small drops probably over the last 4 to 5 weeks, but it's got to that stage now when I've started looking at 10-year swaps as well. That's how exciting it's got. So 1 year's, I know, 1 year's sitting at just below 4.5, where it's been sitting for a while. So it's about 4.47 this morning. 2 years at 4.08, so it's just dipped back into the fours at 4.08. 5 year is at 3.655, and 10-year swaps, that I don't think I've ever mentioned before, is at 3.574. I just find that one interesting because as rates start to drop, and we'll touch on this later, Richard Mack, as rates start to drop and they start to look a little bit more tempting, you start to think, is 10-year ever going to start looking appetizing again? And I mentioned this to the panel just before we came on. My last 10-year fixed I sold back in July 22. And that was for 1.99% at a 10-year fixed. So nice. There is a market for some, but I haven't sold one for, just over 2 years now. And I still don't think it's at that level where it needs to be. It's tempting, especially when you look at the different sort of best 10-year fixed rates on the market versus where 10-year swaps are right now. There's a big margin of difference between the two. But I do find it interesting looking at that. And 3.574 is about as good as it's been for probably 6 months, I think, on the 10-year swaps.
Yeah. And Stuart, is that pricing now really feeding through into you? I know you've cut rates a few times, but are you finding it easier now to cut rates, to compete, etc.?
Well, I wouldn't say it's easy. I mean, we're going to cut rates again tomorrow. I think maybe we haven't announced that yet, but I just have.
You have now.
I think the problem is we cut rates. I think it's the 20th of August, and we've probably done it about 8 times this month already. And it's a little bit in the sort of silly mark because it's a lot of rework for you guys. It's a lot of rework for us. So anyway, the rates are coming down, swaps come down. Lenders typically in August are pretty benign and don't really do much. Completely different this year. lots and lots of activity, and it's feeding through into pretty competitive low margin pricing for lenders throughout the piece. And that is a reflection probably of a year that's not been great for volumes for them, and they're all looking to kind of fill up their volumes a bit, and we're no different in that. So the rates at the moment are very, very competitive in comparison to the swap position at the moment, and it's quite unusual to see such frenzied activity in August as well. Seasonally, it tends to be a quieter month, so a bit strange. It's good for consumers, it's good for the advisors, and I think it's the kind of ray of sunshine that's coming onto the marketplace, and we're starting to feel a bit more positive, a bit more warmth coming through onto the marketplace. I think it will continue as well, albeit it might be a bit of a bumpy road. It won't be smooth, but anyway, overall, it's good but busy.
And Arjun, when you price your products, are you pricing in the same way as a lot of the other lenders? Because obviously you're mainly long-term fixes. So do you price in a different way, or do you price off swaps, or is there other things that you bring into play?
Yes, there are other things. We do obviously use a swap curve as a benchmark. And I would suggest Lee starts monitoring everything over 10 years as well, because you'll find that the 30 year is also about 3.5%, right? So if you only have in a long-term fixed rate mortgage 5-year ERCs, and the price difference is very limited, why would you take a 10 and not a 30 or anything like that? Because you protect yourself against the market vagaries that you can have. If we've seen in the past how volatile that can be, and be protected at its value. So we do that. We have obviously also a margin to consider. We can't subsidize our mortgage margin with deposits. So we get our money from insurance companies, and they charge a proper margin for the risk. So that's the challenge that we have. So we don't want to compete on rate or on price. We are saying to borrowers, if you need that extra leverage, or if you bump into age limits, and you need that certainty, that's when you should just consider a long-dated fixed-rate mortgage, because that's the product for you in those instances.
So for those people watching who don't know much about you guys and Perenna, do you want to give a brief sort of overview? And also then I'll be interested to know actually, because obviously you're Dutch act, and what differences you've seen versus the Dutch and the English market, but just give us an overview on you guys.
Yeah, so Perenna is a new type of bank. It's a bank. It's a different bank. We don't really take a lot of deposits to fund mortgages, but that's probably the continental reform insurance companies, and that allows us to attract long-dated money. Mortgages. And again, we're not trying to compete with the market. We've been for a long time. 2000. At the end of 2007, there were 6 times, and there's still 6 times. And there is a real affordability problem. The regulations that came in basically stop lenders from lending what they used to do. The way to make that housing affordable again is through long-dated fixed-rate mortgages that meet the regulations that have been introduced. And that's an interesting thing compared to the Netherlands, for example, where we've always had long-dated fixed-rate mortgages. The Netherlands started to cap leverage and lending by the banks early 2000s already. They saw this leverage building up, and they started capping early 2000s.
Right, okay.
When we started capping after the horse had bolted, basically.
Yeah.
So we never really got to the problem. That also meant that long-dated fixed were more promoted by the regulation, so to speak. So you can only borrow to your maximum if you fix for at least 10 years, for example. So the government seeks that protection. And our house price incomes in the Netherlands are I think, about 4.5. Roughly, they've never really exploded to that level that they have here because of that constraint that was there. And in the Netherlands, you have a different product. It's a product where there are ERCs for the full term unless you move house. We have a product that, because people here aren't used to ERCs, that says only 5-year ERCs, like the 5-year product. So it is important, and all our research says that consumers like the stability, they like the extra leverage. They don't even care about the rate too much. It is more the monthly payment that is very important, because they want the house. right? It's important to
yeah,
get a house.
absolutely.
That's more important. If you can skip a ring on the ladder, if you like, by getting an extra bedroom, that saves you in the long term, right? So that's the most important thing to them, and we can give them that. But they want flexibility. You cannot lock people in, right? So that's where the importance of the ERCs comes in.
That's interesting. And Lee, from your point of view and your clients, have you you mentioned before that the last 10-year fixed rate you sold was a long time ago. Do you sense that with products like Perenna and also, hope you don't mind me mentioning, also April, who come in as well with similar long-term fixes, although there are differences between the two. Do you think the time is right for this type of product? Are you sensing that with your clients at all?
I think we touched on this earlier. For me, I think my clients that are first-time buyers that are trying to get their foot onto the ladder, they're looking to get as much leverage as possible, and that leverage to get them on the ladder only really comes by long-term fixed rates, such as 5-year. You know, we haven't explored much more than 5-year at the moment, but as interest rates carry on dropping, you know, when you start to see a 10-year swaps getting closer to 3, then it's obviously something you're going to start thinking about there. But 5 years cropping up in conversation more now as rates have started to settle. But for longer term clients, for clients that are just remortgaging, it's still sticking with trackers and 2 years. 3-year creeps into conversation a little bit more, but it's still the shorter duration for those that are remortgaging and don't require leveraging. That is preference at the moment, I think, for them. I certainly see the market, and I see the attraction of a 10-year or 15 or 25 or whatever. But for me, the clients are still looking at the shorter term to try and, in their eyes, it's building up equity quicker because effectively, they have that option of remortgaging, continuously chasing lower rates every 2 years, 3 years, 5 years, and where you reduce that rate in the future, you can build up equity quicker.
It's quite interesting. I've pondered this issue a lot, and having spoken to you, Arjun, and a couple of others in terms of longer term fixes, and that whole trying to change a mindset, and it's not just of the brokers, it's not just of even the clients themselves, but it's even like the media, the press. It's everything is very much geared around cheap, short term, rather than actually looking long term. And I know successive governments have said, 25-year fixes will change everything, but it's never been able to be priced properly, and it's never, before you guys came along, it's never really been able to change things like long-term early repayment charges, and now your charges are only 5 years, and you've got some extra borrowing capacity, and there are various other things. So do you think you're starting on that journey? Are you starting to see people contact you maybe directly, or brokers really engage with you now, or is it very much a long-term play?
It's well, we don't know how long it is going to be, because you're absolutely right. It is a mindset change, and it's a market that's very fragmented. The press looks at cheap, and that's what every industry basically is.
Yeah.
But it is cheap. It's actually cheaper than it should be. So people should more think about, am I missing something, right? That's one thing, because the rate's a loss maker for the bank, and everything is funded with deposits and subsidized. So there is something there. Is it too good to be true, which people should think about?
That's interesting.
That's the affordability boost, but because that's the psyche, we get very good traction in particularly the forgotten segments, the underserved segments in the UK, which are growing fast. Right, the first-time buyer, home buyer segments are growing fast. Later life segment is growing fast with the cost of living crisis, etc. Those are segments that can only really be accessed, and the banks don't want to access them with an SVR product. They can only be accessed with long-dated fixed, and we see more and more insurance-linked lenders, or the likes of April, the foreigners almost, so to speak, to come in and say there is a market for this. We can get the market as much as they like. And the affordability boost is important. It's our USP. We say brokers just use everything else and then run it past our calculator. and you put your 2-5-year product in there, you'll see that there is, compared to the 5-year, there is still a big affordability boost if you were to lock it in later. Because the SVR is an interesting notion. I think we're the only country that allows an SVR. Imagine enter into a contract where the lender, after 5 years or after 2 years, can set the rate at whatever they like. That goes so against consumer duty and anything.
I totally agree with you there.
It's like, really? No other country allows this, right? So it's really strange. But anyway, we are where we are. So we have to just show people that this is a product that can get them into a better life, into a safe life. And there's definitely, it's not going to replace everything. I think we've lost about, we have a mortgage market that's probably 30% smaller than it should be compared to other markets, and that 30% can be made to work because of long-dated fixed-rate mortgages. But that will take time, and it'll take different distribution and marketing, etc. And the press, because the press, it's clickbait heaven, right? It's all about what's getting. And the real thinking behind it and the real education that the press should do is just not there, in my view. But that's a personal opinion.
It's a work in progress. So, Stuart, from your point of view, around, are you seeing any trends in the rates that people are taking at the moment with you guys? Is it as Lee says? Is it still, the short term at the moment, or a longer term? I'm still very much quite a 5-year boy. I pretty much have been for a long time. Because I like I think security is important. And actually now you're getting 5 years starting with a 3. That's good. And I actually agree with what Arjun said around people are looking at the monthly payment. That's what's important. And actually the rate it's not irrelevant, but you know what I mean? It's all about, can I afford it? What's my monthly payment? Is that realistic for the next X amount of years? And also, as some people, we've lived through things like, and I hate to mention her name, the Liz Truss debacle. Boom. And people still remember that. So they still know that things can go wrong. Something can happen, and all of a sudden rates start to spiral. So what are you seeing?
So it's a good conversation. This, we're still seeing the trend to a lower, shorter term, and I think the psyche of the market it plays on this. It moves in different cycles, 2, 3, 5, 10, whatever, but it definitely plays in this cycle, and we're seeing probably more of that at the moment. And there's some logic to that. It's not irrational. Interest rates are definitely coming down. The base rate's definitely coming down. Guesses around how fast and when is still uncertain, but there's some logic to it, and I think so that's kind of what we're seeing. I think we can get mixed up a little bit with this long-term fix though, about rate and product and comparison. This as well though, because you really should be comparing the rate. In my view, consumer choice is the most paramount thing here. So I would welcome people like Perenna and April and Kensington and people like that coming into this marketplace and offering that, but they're offering a choice around affordability and flexibility and certainty. And that really shouldn't be confused by just the rate itself. Those are genuine benefits there. And any advisor should see this as massive opportunity, because typically the big six don't offer these things for very good reason, because it doesn't fit their funding profile. So they don't want that type of money sitting on their balance sheet. And therefore, that's why Arjun gets his money from insurance companies. And so the advisors are in a power position then, because they're offering choice and flexibility beyond the top six. Can do that, and that's demonstrating genuine worth and genuine advice to different types of people. One product does not fit all people though. So we want 2-year, we want trackers, we want 25-year fixes as well. We want a whole spread being available to our consumers, and then having a really good advice structure behind that to allow them to navigate those waters to find the right product for them in the right sort of way. So right now we're definitely seeing a trend on the short term. I see rational. My mortgage is on a tracker at the moment, so I can see the logic in that. But as rates normalize, as swap rates and the base rate comes down to a more normal level, 3.5, whatever that might be. I think it just raised the question now, without that kind of downward projection, what should you be choosing now? A high affordability product like Arjun's offering, long certainty, or other quite legitimate reasons. Now I want 2-year fixes because I can build up equity faster through that process. All of these are the right answers. Just depends which consumer you're talking to.
I think a lot depends on attitudes to risk as well, doesn't it, Stuart? And when you're dealing with our market, and I should imagine a lot of the brokers out there now have had an influx of first-time buyers. So first-time buyers is a big part of our market right now, which has replaced probably the biggest part that used to be buy-to-let, funny enough. And first-time buyers, their attitude to risk is a lot more adventurous than it would be for someone who's older. So the older clients that are 10, 15 years away from their mortgage being cleared tend to look for that budgetary certainty of a longer-term fix. The younger clients are prepared to play the markets a little bit and are a little bit more adventurous. And perhaps that's one of the reasons why they look at the trackers and the 2 years and the 3 years, because they're prepared to roll the dice again in 2 years and see where the rates are going to be. They've got that attitude to risk and that time to recover if they've made a bit of a mistake. But the older clients that are looking to max fund pensions, have budgetary certainty and know that they're ready to go and the mortgage is cleared at the end of the term tend to be the ones, in our experience, that are the ones that like that longer term fix, unless, we said it earlier, Arjun, unless they need that leverage to get them to the property that they want to buy.
Go on, Arjun. I was going to be devil's advocate there. Go on.
No, I would add, you've just also highlighted why the Bank of England and the mortgage rules are not going to change. Right? They are going to cap that leverage because they are going to protect the future, the first-time buyers, the young people against themselves running off the cliff. Right? So if they want this extra leverage and they want to buy the house, you have to, as a first-time buyer, reduce risk. Otherwise, the entire system is at risk, and then the government will need to step in and help all these young people. And if you mess up early in life, you're going to have a lot of issues later in life. We're already under saving for pensions, right? If you don't have a home, you're storing up problems for yourself, but also the system as a whole. So the Bank of England, I think, is very careful with respect to leverage, particularly on the vulnerable segments, such as first-time buyers. That's my view.
You could flip that argument around the other way, because actually you should be saying, particularly with a product like yours, Arjun, that's got a 5-year ERC on it, you should be giving the certainty to those first-time buyers in that position, particularly because typically they'll be able to get a bigger loan with you than another mainstream lender because of that, which typically is more appropriate or is a bigger need or requirement from their point of view, and they can do it. The problem is with that, and this is it's a completely legitimate point. They will look at a 2-year, and typically they will see it as cheaper. Maybe not quite now. It depends. I haven't looked at your rates recently, but typically they would see that as cheaper, and therefore they would be able to reduce that monthly rate. And there is a genuine kind of dilemma for first-time buyers within that process, because if I can afford the loan here, I just now want the cheapest rate because I've got to refurnish this, I've got to paint and decorate and all these sort of things. And you can see why that dilemma comes through there. Whereas actually, if I can't actually get on the housing ladder, one of the 30% that you're talking about, because they can't actually get a loan big enough to buy what they want, then actually the rates are relevant at that point. I've got a loan, it's based on this one, it might begin within 5. It doesn't really matter. I've actually now got on the housing ladder and I can afford that amount because it's fixed for it. So there's genuine debate here. Our market funding structure is not set up for long-term fixes. It's a very rational reason why they haven't been developed here. Now, doesn't mean they shouldn't be, though. There's quite a number of ways they can be brought to the marketplace. And, Arjun is a bank that's doing that. And I think the advice process and mortgage advisors should really be championing the charge of this, because this is a clear differentiator for them. They can clearly differentiate their added value to their consumers by explaining the difference between a 2-year fix and a 30-year fix. And there's genuine pros and cons in this. That is a quality piece of work for people to understand. Very difficult for Joe Average to understand that as well. And I think that empowers the advice, secures the advisor's position in the marketplace, if it needs any more securing at 91% market share. But anyway, type of
can
only
always have a
91.
bit more secured. Yeah,
Yeah, exactly.
I'm disappointed with that. Disappointed with that.
Those silly 9% going direct.
Yeah.
I agree with that, Stuart, and this is why we are educating the market. We are offering all the tools that we can give to brokers, and we do say go and check all the products, the short, the 2, the 5s, and hours. That's why we've launched an SVR calculator. So find another 2 to 5 year product for your customer, then run it through the 2-5 year calculator and see what the affordability boost is, and then just discuss with your client what the difference is and what your client prefers to have, the extra 20% and an extra room, or the cheaper rate and refurbish it and repaint a smaller flat. I mean, those are just genuine discussions to have.
Many people will still go for a 2 or 5 year fix because it's what they've known, and they've remortgaged 4 times already, and they're comfortable with this rate. Yeah. That is their right. That is their choice. The consumer is king. We should just be guiding them through this to make sure they understand the risk.
Yeah.
We shouldn't be biased in one way or another, but being offering genuine choice is the advantage of whole of market advice. Yeah, that is why it becomes prevalent.
I think that's the key here, isn't it? That's the key here of having lenders like Perenna and April on board, is that we do have more choice, and having more choice is going to enable us to help more people out there, because not one size fits all at all when it comes to mortgages. Everyone's circumstance is completely different. So having these added options that Perenna bring and April bring, people like that, just enables us to help more people get on the ladder. And then, we take it, every scenario is going to be different. Every borrower is going to be different. So we don't have a big market for the long-term fix at the moment, but it is creating more avenues for people to get that first foot on the ladder, which is what we need right now. So, for us, it's not a huge market, but I do think it may get bigger, and it's nice having that choice there now for the clients to look at that.
Yeah, I think that's what I was excited about talking to Perenna and April over the last couple of years. Really, it is finally we actually have that choice, because finally that you've both answered a lot of the issues that we were raising and that our clients were raising in terms of long tie-ins, etc., etc. It's quite interesting. There are sort of devil's advocate points all over the place here. One is, Lee, you're saying a lot of first-time buyers, younger people are more willing to take some insurance, interest rate risk, etc. Are they, or is that actually what advisors are advising them to do? And are advisors not being negligent's a wrong word, but not being, they're not really discussing, as Stuart so eloquently put it, the whole range of products available? Actually, are they falling into the trap themselves and just really looking at the 2-year track and the 5-year? They might now and then add 10-year, but we should have surely sold loads more 10 years at 199, shouldn't we?
100%. And it was lower than that as well. There were 10-year fixed available that were lower than that. But I think brokers fell into that trap 4 or 5 years ago when every deal was a 5-year fix. It was simple. It was order taking. Everyone did a 5-year fix. I think over the last couple of years, brokers have worked hard. They're doing their job a lot more diligently. And I think brokers are offering a lot more options to clients. I think they are doing the job properly. I also think we've seen a lot of brokers leave the industry as well, because the job has become so diverse and it's not as easy as it used to be. And it is a lot more laborious. It has put some people off. And I don't mean that disrespectfully to those that have left, but the job is a lot harder now than it was 2-3 years ago, because there's so many options available to clients. We have to make sure we outline them all. I think brokers, sorry, Stuart, go on.
I think hindsight's a bit 2020 here as well. So I'm just going to come back and be the broker's champion for a minute, actually. Because, if we go back to...
Don't get me wrong, I am the broker's champion.
Well, no,
but I've got to say to you, what you said before was that I couldn't have put it better myself, that choice. And
But if you go back 2 years ago when Lee did his last 10-year fix, Argent didn't really, business didn't really exist at that point.
No,
it wasn't
exactly.
really a genuine choice at this point, and therefore people weren't being educated, weren't really being given the option.
Yeah, agree.
And also, I bet that 10-year fixed rate came with 10-year ERCs.
Yeah, it did. That was the problem.
With
5. That was 5.
Oh, okay, fine, okay. So that's anyway. But all these things were there 2 years ago. They're not so much now. There is a genuine choice here, and also it's a bit unfortunate. About 2 years ago, we had Liz Truss that spiked up interest rates, and everybody knew, and everybody knows they're coming back down. So I think the timing in the very short last 12 months has not been really playing to, Perenna's or April's or Kensington's advantage.
Yeah.
In the marketplace. Now, as we come down and things level out, probably in the next 6 to 9 months, I think there's a whole different debate to have at this point around what is right for the consumer and how does a broker really generate or offer and create real whole of market advice processes, because the real genuine choice is now spreading out there. This is all good news for brokers. You've got to embrace this.
Totally agree.
So I think we shouldn't be too harsh on going, why didn't we sell more of these 1.99 10-year fixes? Because that 2 years ago was a long time ago. And we've gone through a turbulent time in the last 2 years. Now, going forward, I think is a much better way to focus on this thing. Because I think going forward, the answer should be different. And I'm not saying 90% of people are going to buy 25-year fixes like in the US. It's a different market, different funding structures, different things. But should it be more than 1 or 2%, which is what it currently is? Absolutely. Somewhere in between the two lies the answer.
Yeah, I totally agree with that, and that's why I was excited with these two, Perenna and April coming out, is because we can genuinely have a proper conversation now around it, which is, and I hope more brokers do look into it, and I hope they do have that. And as you say, Stuart, it's a tool in our box. And as a broker, that's what you want, isn't it? You want as many tools as possible that differentiate you from someone trying to do it themselves or trying to go direct, and getting proper advice. And now we can advise on 15, 20, 25-year fixes as well as the 2-year trackers with no penalties. That's brilliant.
Yeah, 100% mortgages. There are options out there. There's a lot more options than we've had for a long, long time. And I think the brokers should be stepping up and coming to the fore right now. And in defense to brokers, I think they are. I think brokers are engaging more with their clients than they ever have done.
Yeah, agree.
The danger of complacency setting in. A 91% market share is an all-time high, and it can only go one way. Yeah, I don't know why or how or if and but. I don't know. So, but it can't get, it'd be highly unlikely to get higher. It's far more likely to get lower. Like a normal natural would be 60-40, 70-30 type, if you go historically back. So
that's what we always dealt with. Yeah.
Exactly. And so now technology is going to come in, and it's going to mean that brokers are going to do more mortgages, more advice, faster and quicker, and it's going to be a requirement because it's going to become more efficient. There's also going to be demands on them as well, and also inevitably at some point B2C work is going to steal some of that market share back. Again, don't know why or how, but it's just inevitable. And so therefore, why is this such a having product innovation? I mean, you could talk about Generation Home as well and the way they bring type of stuff in there. You could talk about us bringing in different type of technology, April and Perenna. All these things are great news for brokers because basically this whole of market approach helps protect that position for them and helps them to identify ways of giving genuine consumer advice through this process. And we should.
So Stuart, you've obviously read my non-existent script because that is a genius segue into sort of something else we were going to be talking about, which is tech and how it's
Well, I'm actually worse than you, Monty. I was given the script, but I haven't actually read it. So
well, you weren't giving it to me, so I don't know who wrote the script.
I was always making it up.
So that's a really interesting debate, and obviously we've seen a couple of lenders who've done some direct to only some rates who are cheaper direct, only a little bit, and it's the same couple of lenders who seem to do it every now and then. And I guess as brokers we all get on our high horse and then we sort of forget that it is a 90% odd split, and there needs to be some fairness. But I'm going off track, but sort of the technology that's
the choice again. I think that's a good
yeah,
thing.
I agree. It's choice.
And I
Yeah.
think it brings pressure to brokers to keep them honest as well. We want the consumer, wants a competitive landscape. They want brokers to have to work hard for their money, to be honest, because that's what gives them best value. So lenders coming out with B2C propositions, which will be priced without procuration fees and lower origination costs, which is why they're cheaper. They'll have passed all the consumer duty rules and all that sort of stuff, and that will be completely transparent internally because they're not insane. So it will be fairly proportioned and priced in that way, and it keeps brokers honest, and that is to the consumer's benefit as well. Now, it might not be to the broker's benefit, but that makes you more honest, keeps you doing the right thing for your consumers, and that means you're more likely to keep your market share. So this is good news. We should never ever worry about consumer choice and champion the consumer best outcome, because it creates a really healthy market dynamic. And that's part of the process, in my opinion.
I guess what we've always wanted as brokers is, and I'm sure Lee will echo this, is a level playing field. So
I bet behind the scenes, the pricing on that will be complete. I mean, they'd have spent more time on that pricing, and they'd have got more nightmares and more risk committees on it to make sure it was fair and reasonable than you could possibly imagine, because people are so scared of consumer duty, they wouldn't take an outlier. I don't know. I have no knowledge of it, but I would be amazed if it's not completely black and white. And because I know how I would do it, I know how I would price it and go through my government structure, and I would be down to the penny. It would be the same cost base underneath it. It's just cheaper to do. And
there's no advice in that either. I think it's purely the execution.
There's no advice at all. No, and that's part of the problem.
Well, you cannot advise on a product where you yourself have the right to set the rate at whatever you like after 5 years. Right? How are you going to advise on that? That's the biggest conflict of interest ever.
The devil's advocate to that, every single lender in the land now does everything it desperately can do to make sure no one goes on an SVR. And the actual rates of SVRs now are dropping rapidly, and everybody will avoid it because again, every lender is running into consumer duty. Quite right. This is all good news, by the way. Consumers are getting better deals, and behind the scenes, the industry is actually looking after themselves. Might not be exactly the most efficient way of doing it, and it might be a bit of a blunt stick to get to the end of the game. But these are good things for consumers coming out of this. So the SVR is a very important debate for affordability, not necessarily for pricing, because very few people on the SVR.
Agreed. Although, from an advice point of view, if you have that power, then you will not exercise that power unless you're in real trouble. Because you could see that after financial crisis, every loan basically went to SVR and all the banks stopped lending. So there is, and that's what the regulators look at, right? So,
but the regulator,
I'm sort of with Arjun on this around the SVR debate. It's a really interesting one, but you still got SVRs at the moment which are around the 8% or high 8%, and it just seems crazy, doesn't it? The whole SVR thing seems really anachronistic now, doesn't it?
And for a lender point of view, from a consumer duty point of view, actually removing the SVR construct in itself is an extremely difficult thing to do. We look at it all the time.
I get that. Yeah, it's going to be difficult. Yeah,
and we do a whole different podcast on why SVRs exist. There's legitimate rational logic behind them, even though it seems rather illogical. But what you really want to do is you want to keep that SVR in place at the moment from a consumer duty point of view as well, but you just don't want anyone to use it. Yeah, and you want to make sure that everybody buys a different new business rate if they're doing a PT or Windows.
But we know they don't, and one of the reasons they don't is because the product set on the PTs isn't available. So, for example, some lenders will not have a PT which is a tracker rate with no penalties, which is actually what a lot of people would do. So because they don't want to tie in again, I know we're getting off subject, but because they don't want to tie in again, they feel that they either have to stay on the SVR because they might sell in a year or they might do something different. And then in a consumer duty world, you're treating customers unfairly in that way. You're forcing them onto a higher rate.
But there's no perfect solution in the world, yeah. And if you look at the uptake of SVRs now, they're at the lowest rate that's ever been in the industry. So the days 10 years ago when I used to run mortgage businesses and I used to optimize my position knowing 30% would be on SVR, and I can manage my back book and my front book and optimize pricing and margin, which is what lenders did quite openly in the market. It doesn't really happen anymore. Very few lenders are monitoring this SVR position like that, and they actually try and you can see the actual only when you almost can't get the consumer to take something else to the SVR become applicable. And that is the mentality in lenders at the moment, all driven by the consumer duty environment we find ourselves in.
Yes, but you're right. But this comes back to one of the other things, and that is people pay a lot of early redemption charges and breakage costs. And that is the alternative, because you can choose a 2-year, but that's not flexible. You can pick a 5-year, it's not flexible because you have ERCs during the 2 and 5-year period. And after that, you go to an extremely high rate. So you have to be locking yourself in. So you're constantly, so if your life changes and you have to move house or you have to do anything, you will pay ERCs. And I think
you port or do a further advance. There's good ways the industry protects it. I'm not saying it's a perfect way.
I think that it'd be interesting to know how much the lenders actually make in ERCs, and I bet you it's a hell of a lot of money. But I will.
Buy-to-let lenders.
It's a lot.
So there's a different position here, and so again, if you are a mainstream lender, you will look to try and absolutely not optimize any margin from an ERC position. You'll be looking to manage a genuine breakage cost, which is what it's there to do, and you constantly review the ERCs up and down to make sure you're not trying to inadvertently make money at it. We look at this all the time. We absolutely are desperately trying not to make money at an ERC from a consumer duty point of view. So there's controls and mechanisms within a very practical way to help sure the consumer gets all the right deal. Does every consumer get the right deal? No, I understand that. I think this is not a perfect world, and there are blunt tools in this country to try and manage risk, as Arjun has pointed out, LTI and all that type of stuff. But also, it's not fundamentally broken either, because things are being behind the scenes managed correctly. But bottom line here is what consumers should be doing is they should be taking regular advice, because the broker community will be able to manage this risk for them by either remortgaging them, managing a PT for them, or just genuinely arguing with the lender to get the right result. And again, it goes back into the broker community and the benefit of the broker community within this market. Just do a good job there. It was probably on the script.
And that's brilliant, by the way. I could listen to that debate between you. I think we need to have like a one-on-one SVR debate. That'd be brilliant. I love that. But I do want to cover in the last 5 minutes or so just a little bit around tech. That's been brilliant discussion. Who needs a script day? It's great. So obviously coming into the UK from the Netherlands and do you think that the UK is behind technology-wise
100%.
in terms of the mortgage market? And what are you doing?
I don't even have to think about that. It is so far behind. It's just, obviously, Stuart, the origination systems are increasingly being developed, and the front end towards consumers is where all the investment goes, right? The back end is very difficult to upgrade, and the lack of investment for so long means that the servicing system, the core systems are really outdated, and they stop really being efficient, right? But that's just in the lenders. Then you've got the sourcing systems that are old tech as well. So you can't put different innovations of the type of products in there, right? You know, your hybrids, for example, that LNG is developing with the Rios and the part roll-up. Can you get that into a sourcing system? Well, probably not very easily. And the costs of getting that in. And then the whole conveyancing and the way the whole market interacts with each other and you know, the land registry. I mean, really, we are so behind the curve in digitization and technology in the entire housing mortgage market. Compared to other countries. And I spend a lot of time working in other countries, in many other countries, and we are really far behind. And we all need together to just say, look, let's just sort this and make it work properly. Because the fact that it takes you 3, 6, 9 months to buy a house and complete on it is just not right. It's just not right, right? How many times do you need to chase people for silly little pieces of paper that you just shouldn't have to look for? Even they should be just stored somewhere, right?
100%.
And tech can change all that, right?
I think the conveyancing has a lot to that needs to digitize quickly, because it's great and more lenders are moving to getting mortgage offers out. You know, not just saying it because Stuart's here, but they can get their offers out. What was it, 22 seconds? Your fastest mortgage offer, was it, Stuart?
20 seconds actually now, Lee.
Oh, it's gone down.
20 seconds.
But a lot of lenders now can get it issued in a day. But if that offer's expiring in 6 months and the conveyancing still hasn't caught up, then it's pointless having that tech if it's going to fall down elsewhere. So the conveyancing part is what I think really needs assistance, because lenders, I think, are stepping up and they're getting things moving a lot quicker than they used to.
Yeah.
And Stu, you're the or I've just called you Stu there. Sorry, Stuart. I don't know. Just it's all right. I know this is like mates down the pub talking. I should be a bit respectful, I suppose. So you know, you guys obviously come in and done a lot in terms of tech, but I know we've had conversations in the past where you're like, we're still not doing what I know we can do. Where are you on that journey?
Yeah, I mean, look, and there's two moments of truth for the consumer. Let's go. I mean, I always think about the consumer in this process. There's two moments of truth. Have I got my house? And the day I move in, everything else is just paid. Yeah. And when you get your mortgage offer, you know you've got your house. No matter if it's been taken off the market, until you've got the offer, you don't really know. And for the consumer point of view, it's a moment of truth. And then the conveyancing piece kicks in, and then whatever period of time later, the day I move in is actually the genuine moment of truth through that. And there's separate problems there. From our point of view now, is we are focused on that first moment of truth. So if you look at this month, I mean, we're originating quite high volumes at the moment, probably be a top 10 lender in the next 12 months. So this has been done at scale. We would do, if you package a case correctly, 94% have been done in a day in August.
Wow.
And so we are delivering quite significantly now. Now, our complete focus now is to make our system so intuitively easy for brokers to use. The cases are packaged properly, yeah? So about 1 in 3 cases is done in a day because packaging is not quite right. And that's because either a broker doesn't have the information, or we haven't asked the right question, or whatever. There's lots of different things. But what will happen, certainly by the end of this year, we think one-day mortgages will start to become a normal thing. People should start demanding that. And it's not about fast mortgages. It's about certainty and broker time. Yeah. No chasing lenders, no 2-hour application forms, genuine real time back in the broker life. And the consumer has got certainty. These are the important things. Fast is irrelevant. It's the derivatives of that stuff. Once the marketplace has nailed that, and it hasn't yet, but we will, absolutely, it shines a light on conveyancing, and it becomes so clear how bad that process is. The more and more work will be done on that at the moment. But it's hidden behind the process at the moment because the front end wasn't very good anyway. So the fact of the moment is you've got to fix it kind of in order, in my mind, to get things going. So this is kind of how we're seeing the marketplace at the moment. And, we work with all the big lenders at the moment. We have 2 businesses. We MPowered mortgages.
Yeah.
All the big lenders can come to us, and we talk to all the big lenders about using our technology. And again, why is that good news? It's about saving brokers time, making sure that they can do more or go for a round of golf or just get a bit of balance back in their life which has been sadly been destroyed in the last 3, 4, 5 years or whatever. So we're working with those lenders to bring that to the marketplace, and we're also that conveyancing piece is next on our agenda as well too. So you'll hear more about that next year from us.
That's interesting. Lee, what I know you said about conveyancing. Is there any other process that you still think we've got a way to go on in terms of the tech?
It's,
I know
it's mainly conveyancing for me because, I've spent time in Stuart's office and it's a phenomenal outfit. The way it works is incredible. I can see that, you're saying you're going to be a top 10 lender within 12 months. Your pricing is always spot on. Your change of price happens quick. I presume that's because of your systems in the background that allow you to facilitate that. So you'll normally, if you know rates are going to drop, 9 times out of 10, MPowered are one of the first to drop. You do it quickly, and the offer is done quickly. The processing, when you submit a case with you and you watch it on the system happening live, it's quite something to behold. And then you compare that to where conveyancing is right now. I mean, I don't know how long it's going to take to get conveyancing to the level that you guys are at, but for me, it seems a hell of a long way off.
But it's a different problem. We need a different solution. And I can't really, we do have a plan, and we'll work with different people. We talk to people in the marketplace who are doing the data projects and the new players coming in to the marketplace. We're in very active conversations around this. But in reality, it's about a communication exercise. It's about making sure people know exactly who is the last or the weakest link in the process, so to speak. And it's about bringing complete transparency and then peer group management to it. And if you're chasing a case, you're not chasing the lender, then you're not chasing the broker, the solicitor, or which solicitor. All this stuff is being done at the moment and wasting a huge amount of time. And in the end, people just give up the will to live. It's about being absolutely transparent. So imagine a WhatsApp situation, the message being read, 2 blue ticks, the job sits with that person. So everybody else in that chain just phones that person. And the peer group pressure starts to then innovate the process. Because if you think, broker CRM systems is a cottage industry, and it is a little bit, the solicitors behind the scenes are even worse. And you have to force transparency and pressure onto that. And the only way to do that is by creating a clear view of who is the weakest link in that chain. That will start identifying the right problem statements, and then the right solutions can be start applying to this. Now, more of this will happen in 2025 from MCube and MPowered Mortgages, and so we'll start to bring solutions to that. But yeah, it will be in that guise of how the solution will be packaged.
How is that process in the Netherlands, Arjun, in terms of the conveyancing? Is it as arduous as it is here?
Well, first of all, it's in the nature of people to complain, right? Because we want everything instantly, and we don't like anything buffering anymore. I heard someone complain, not in the Netherlands, this was in Denmark, about it taking a week to do this, and it's like, okay, and this is Denmark, not the Netherlands. So, and they are more efficient than the Dutch probably, but I can't really tell you anymore what it is in the Netherlands. I need to figure that out and ask the question. But I know in Denmark it's even quicker. It's the most digitized country in Europe, I think.
Really?
Wow. But people still complain about it, right?
What's the average from kind of getting your offer accepted to completing on a house out there, for example, that process time?
I'll tell you, but it's fast. It's fast. Yeah, it's very fast. I will get the data for you. But
that'd be interesting actually to compare. I think
I don't want to make it up here.
Yeah, it's I spend my life making stuff up. I don't worry about it. That's how Lee hasn't got a clue what swap rates are really. He just makes it up. I'm joking.
We all know your laptop is in Corfu, Monty.
I wish I still was. Yeah, so I know this is subject for another time, but it's interesting all the work that Maria Harris is doing, the Open Property Data Association, in terms of the home buying and selling process, fully digitizing it, and I know they're doing a lot of stuff with government. So, and they're starting to make leeway on that. So maybe that's another one of these. We'll get Maria on with you, Stuart, and and actually, talk about some of these things. That's very interesting. But we are sort of running out of time. So I just want food for thought. David Goose has just sent one in. I guess this is about sort of the broker versus lender. He got something from Halifax that said that one of his clients got. As we already know you, it only takes 10 minutes to apply for a new deal. If rates go down, you can cancel it and choose a new rate for free. Just give us a call. Either way, there's no early repayment charge, legal fees, or valuation charges if you stay with us. And no comment or warning to say these rates are ours only. There may be better rates elsewhere, and nothing about advice.
So there though, Monty, who would notify that client that the rates have gone down? It's on them to check that, presumably, because the lender wouldn't.
Yeah, I mean, that's exactly the point. They're probably sitting there thinking, oh, well, they'll tell me if rates go down.
Yeah.
But, so it's interesting. I think that's we can delve into that maybe on a future one. Maybe get on one of these lenders who is starting to do that. But that's all food for thought. Thank you very much, all of you. I found that absolutely fascinating. Really, really good. So thank you so much, Stuart. Thank you, Arjun. Thank you, Lee. That's been brilliant. I've really enjoyed that. I feel I've learned a lot today. Thank you all for watching. Hey,
less scripts.
Yeah, exactly. Who needs a script? But I do need to shout out our Star Broker of the Week at the end of each webinar. So please tag MPowered on socials, or you can nominate a Star Broker on the MPowered website. And a big hello, Darren Hunter at Hunter Wealth Mortgages. Shout out to Darren for his fantastic service in supporting first-time buyers to secure a mortgage under challenging conditions. Darren's clients praised him for his compassion and commitment, working flexibly around their schedules to provide much-needed support for starting their journey on the property ladder. Well done, Darren. That's what we do. That's why brokers are brilliant. So remember, we are bi-weekly, so we're not here next week, but back the week after, hopefully with a fully scripted show. You can listen to all of these on Spotify podcasts. If you have enjoyed it, I've been Andrew Montlake. If you haven't enjoyed it, I've been JD Vance. Bit of American politics for you there. Until next time, have a great week.